Hello? Hello, everyone, can you hear me? If you can hear me, just type the type emoji or just type one in the chat and let me know you're with me, okay? Not pretty sure if it works well. Well, okay. Hello everyone, welcome back. I am the host of the USMK Insights channel, here to help you understand the US stock market and avoid common pitfalls together. Let me quickly greet any new viewers. If this is your first time tuning in to my live stream or watching the replay, I want to tell you that this channel is different. We don't use complicated jargon or bombard you with dense institutional reports. I'm just an individual investor, someone who does their own research, manages positions, read the news like Yahoo Finance or other resources from like a Google, and analyze data, then breaks it all down into simple terms to share with you. So if you're like me, busy with work, not able to monitor the market every day, but still want to manage your money wisely and avoid getting caught in the traps of the US stock market, I'd say we're on the same page. For today's live stream, I prepared around 1 hour and a half. We will be diving into a few of the latest news stories to see where the US stock market is heading in the near future, which sectors are still worth keeping an eye on, and which pitfalls we need to avoid. Lately, the news has been quite packed. For example, Trump has rolled out a new tax reform proposal. If this moves forward, many large companies, especially in the tech sector and multinational corporations, could see their stock prices skyrocket due to corporate tax cuts. Then there's the banking sector. I have prepared the latest Wall Street reports for you, where we will dive into what's happening in the lending right now. See, this is the second one. Why aren't trading activities making money, yet banks are still rising? There are quite a few interesting dynamics behind this. Don't be fooled by how quiet banking stocks seem. Sometimes their growth can outpace even tech stocks. Next up is the energy sector. We will talk about energy sector. We all know oil prices are king, but what's been happening with hedge funds lately? Why are they dumping energy stocks in such large volumes? What's the subtle relationship between oil prices and energy stocks? There's a lot we can learn from this, especially as retail investors. And then, of course, the exchange rate. We will talk about it. The US dollar is really strong right now. Is this an opportunity or a risk? How much does the rising dollar impact us retail investors in the US stock market? A lot of people don't pay attention to this until the exchange rate swings, and then they realize they've been caught off guard. So today we're going to break it down and analyze it. In short, no fluff, no empty talk today. Everything we discuss will be based on the latest news, and I'll help you plan a simple roadmap for the next few weeks. I will also share my personal thoughts with you. Of course, I'm not a financial professional or some big short experts. I'm just someone who analyzes the market, make trades, and reads the news, then shares my thoughts with you. After hearing my ideas, you can take them as a reference and feel free to discuss them in the chat. It's best if you can make these strategies your own so that when you trade on your own in the future, you will feel confident and not anxious. By the way, I know some of you might not be able to catch the whole live stream today, or you might get distracted halfway through, and miss important points or trade ideas. No worries. You can subscribe and hit the notification bell so the next time I go live or post a new video, you will be the first to know. Another important thing, I've also set up a WhatsApp group and it's completely free to join. Again, it's completely free to join. It's just me and some of my friends. And we use it to share small opportunities or key price points I spot, or to discuss breaking news as it happens. To put it simply, the US stock market is full of ups and downs, and it's hard for one person to keep track of everything. But with more people, we can work together and keep each other updated, right? If you're interested, the link is in the pinned comment and the description of the live stream. Don't be shy, click the link, join the conversation, and feel free to reach out with any questions. I might not be able to reply within 24 hours, but I usually try to respond quickly. I will do my best. Alright, let's get into our usual routine. Before we start, please hit that like button and help YouTube push this stream to more people. The more retail investors who see this, the less likely they're to fall into the traps. Consider it a good luck charm for yourself. Now, enough talk. Let's dive straight into today's first topic. How big of an impact will Trump's tax reform have on the US stock market? This is the first one. Okay, this is right. And is it worth positioning ourselves in advance? Let's take a look at the news together. Here we go. All right, folks, let's kick off today's live stream with the hottest news, the one that's most likely to change the entire direction of the US stock market. Why start with Trump's tax reform? Let me explain it to those who are new to the stream. A lot of people hear the word policy and immediately feel overwhelmed, thinking it's something far removed from their own investments. Some might even think, I only buy Apple and Microsoft. What does Trump's drama in the White House have to do with me? But if you're trading in the US stock market, this issue is directly tied to your portfolio. The US stock market is highly sensitive to policy expectations, especially tax policies, because they directly determine how much profit companies can keep in their pockets. Lower corporate taxes mean more money, and what can companies do with all that extra cash? They can either distribute dividends, buy back shares, or invest in research and development. All of these things provide solid support for stock markets. In simple terms, tax reform is like handing money to companies. Think of it as the US giving companies a big cash bonus. Why does Trump keep pushing for tax reform? To put it simply, it's all about one thing: keep American companies from sending their money elsewhere, keep the money in the US, pay more in sales taxes, pay less in corporate taxes, create more jobs, and invest more in research and development. These strategies are all connected. Other countries do similar things, but the US approach is especially powerful. So, how big of a deal is this overseas cash situation? Many people might not have a clear idea and might wonder, so what if there's money overseas? Let me ask you, do you know how much cash Apple has sitting overseas? At its peak, they had over $200 billion. Yes, not $200 million, but $200 billion. This money has been sitting in low tax regions like Europe, Asia, and Ireland. Why? Because if they bring it back under the old tax laws, they'd have to pay a hefty tax fee on it. So companies got smart and kept the cash there, using it to buy government bonds hedge, or just leave it to earn interest if they didn't need it. But once the tax reform makes it more profitable to bring that money back, companies like Apple, Microsoft, and Google will be able to repatriate that cash. It's like us retail investors suddenly seeing billions added to our accounts. Do you think they won't use that money for some major moves? What will companies do with the money they bring back? The most common thing is stock buybacks. Now, many new viewers might not fully understand how stock buybacks are related to stock prices. Let me give you a real-time example. Imagine a cake is cut into 10 pieces. Now, if the company uses its money to buy back 2 pieces, that means there are only 8 pieces left, right? Naturally, the remaining 8 pieces are now worth more, right? In the stock market, stocks are like those cake slices. And buybacks are when a company buys back a portion of its shares from the market and cancels them. It's like there are fewer people sharing the cake, so each piece becomes more valuable. Let me share a real historical example. Back in 2017, when Trump first took office. One of the biggest moves he made was implementing a massive tax reform. Apple immediately announced that it would bring its overseas cash back to the US and then unveiled a historic buyback plan. Okay, let me show you the Apple stock. Give me a second. Okay. Back in 2017, so give me a second. Okay, 2017, around this area. 2017. Okay, back at that time, Trump first took the office. Apple immediately announced that it would bring its overseas cash back to the US and then unveiled a historic buyback plan, pumping billions of dollars into the market. As a result, the stock price surged. At that time, many people thought the stock was overpriced, but the more it was driven up, the more retail investors jumped in, only to realize later that Congress was saying, wait, we need to renegotiate. That led to a shift in expectations, and funds started to pour out. The stock price quickly plunged. So when trading US stocks, we need to stay on top of these policy moves. Don't just focus on whether the stock price is high or not. We also need to understand what's supporting it and when it might stumble. Keep that in mind. So will this tax reform pass? Trump's new tax reform proposal is already on its way to the Senate. Let me show this page for you. Next, Congress will be holding meetings, arguing, voting, and there might even be some tweaks along the way. Who supports it and who opposes it could be key moments that trigger sudden jumps or drops in the stock market. So think about it. What can we retail investors do? We may not be able to vote in Congress, but what can we do? The key is to stay informed and avoid jumping in all at once. Many people ask, should I rush to load up on Apple and Microsoft stocks? No, a big no. What we should do is first identify which stocks have potential benefits, then find good entry points. We should buy in slowly, in stages, and not use up all our capital at once. Who else can benefit from this? Besides the big tech stocks, some of you might be wondering, are there other stocks that could benefit? Yes, exactly. Manufacturing and pharmaceutical companies can also benefit from lower taxes. For example, companies like Boeing. Let me check. Like Boeing, BA. The ticker is BA. Like Boeing and Caterpillar. Caterpillar, the ticker is CAT. Yes, Caterpillar. This is Caterpillar. These mid-sized manufacturers have seen solid profits, but their tax burden was high. Once the tax burden lightens, their balance sheets will look much better. However, these less popular stocks can be more volatile. Personally, I tend to keep these stocks in my portfolio, but at a smaller proportion. If they go up, it's a nice surprise, right? If they don't, it won't hurt my overall strategy. All right, I see someone asked, USMK Insights host, what if I don't have Apple stock and missed this opportunity? My answer is, don't worry. If you miss it, you don't necessarily have to chase the highs. You can wait until news is clearer and then target other stocks that will benefit, or wait for a pullback to see if there's a chance for a better entry. As long as the policy hasn't been finalized, the opportunity isn't completely gone. And next, another person asked, "Hey, if the tax reform doesn't pass, will it drop like it did in 2017?" My answer is, there's a high probability of a pullback, but compared to back then, the market is much larger now, and the volatility isn't as extreme, unless there's another black swan event on top of it. Let's say you're having dinner with a friend after work, and your friend says, "Whoa, the US stock market is so high lately, I'm afraid I will miss out." You can respond by saying, "Buddy, don't just focus on whether it's going up. This rally is being driven by policy, and if it stalls, it could turn around in an instant. We need to keep some positions as a buffer." This kind of phrasing is something you can use in everyday conversations as well. Next, let's dive into the private community. Folks, remember, it's not about having more information, it's about catching the right information at the right time. What I dread the most is seeing people who don't follow anything. When the market goes up, they chase it, and when it drops, they panic. Then they come to me asking, "What should I do?" So to solve this, let's create a WhatsApp group. Whenever I spot any breaking news, when a vote is coming up, or if an important Congress member changes their stance, I will send it straight to the group. It's hard to keep track of everything on your own, but when we work together, we can watch out for each other and keep everyone informed. Remember these 8 words. Tax reform is a catalyst, not a shield. But what we're doing is using the catalyst to find opportunities, but don't treat it as a get out of jail free card. Pick the right stocks, buy in stages, monitor policies, and adjust your portfolio as needed. These are the small skills that can help retail investors survive. All right, everyone. If you've got this, type OK in the chat so I can see who's still with me. Okay, type the OK in the chat. Let me see. Let me know you're there, okay? All right. Next, let's move on to the banking sector. Let's move on to the banking sector. The banking sector. With interest rates at a high, why haven't the bank stocks flatlined? Why? Why haven't the bank stocks flatlined? Is there an opportunity here, or are we stepping into a trap? Come on, flood the chat with responses and let's keep the momentum going. Please join in the chat and keep the momentum going. All right, folks. We just wrapped up the Trump tax reform discussion and the logic is all clear, right? If you have any questions, type your question in the chat. Now let's follow that thread and shift our focus to the second key point, bank stocks. Why focus specifically on bank stocks? I know when people hear banks, many new viewers might think it's boring and think, what's there to talk about? Isn't it just like saving money, collect some dividend and stay safe? But let me tell you, bank stocks are actually the heart of the US stock market. Why? Because you need to understand that for this market to move, it has to have blood, and that blood is money. So where does the money come from? It comes from banks. Many times, if you want to know whether the economy is hot or cold, you don't need to look at flashy GDP forecasts. The first thing you need to check is whether banks are willing to lend money, how much they're lending, and if they are able to get it back. That's the most real hands-on thermometer for the economy. That's the most real hands-on thermometer for the economy. What exactly makes bank stocks profitable? For us, retail investors, the most straightforward thing we see is lending, like mortgages, car loans, and credit cards, right? Who's behind lending you the money? It's a bank. Banks borrow money from the central bank at low interest rates and then lend it out to individuals and businesses at higher rates, profiting from the interest rate spread. That's why we're always talking about how expensive mortgages and car loans are, right? I remember yesterday I just talked about it. And because for the banks, that's just a pure profit. Is the current interest rate environment good or bad for banks? Let's break it down. The Federal Reserve's interest rates are still high and the US Treasury yields are also decent. A lot of people think high interest rates are bad for the stock market, but for banks, a higher interest rate spread is actually a good thing. Think about it. During the pandemic, interest rates were almost zero. If a bank lent out $1 million, it would have earned less than it does now with $500 million in loans. Why? Because interest rate spread is wider now, so they're making more interest or income just by sitting back and letting the money accrue. So what's behind this good data? The news has made it clear. Many investment banks have seen a decline in trading revenues because retail investors aren't as crazy as they used to be, and IPOs have dropped. But the income from lending has made up for that loss. What does it mean? During periods of high interest rates, banks can still maintain steady profits thanks to the interest rate spread. That's why you will notice banks like JP Morgan Chase, JPM, Bank of America, BAC, and Wells Fargo, WFC, may not have stock prices that surge like Tesla or Nvidia, but they are very resilient. Let me show you. What I just talked about, the JP Morgan Chase, the ticker is JPM. Yeah, this is JP Morgan. This is JP Morgan. And the next one, The second one I talked about is the Bank of America, BAC, Bank of America. This is chart of the Bank of America. And the next is WFC, Wells Fargo. All of them are very resilient. They tend to hold steady even during the market fluctuations. The interest rate spread is good, but there are pitfalls. But my friend, don't think banks are just sitting back and counting money. They have their own risks. One of those risks is bad debt. To put it simply, banks aren't lending their own money. They're lending the money from depositors and shareholders. If someone defaults and can't pay back the loan, the bank is the one that has to cover the loss. Let me share an old story with you. Our longtime viewers have probably heard this, but for our new friends, this is something you really need to remember. When the 2008 financial crisis hit, the first ones to collapse were the banks. As soon as the mortgage crisis struck, people couldn't pay back their loans. Homes were foreclosed and bad debt surged overnight. Lehman Brothers, LEH, let me show you. The ticker is LEH. No, you can't find them. Why? Lehman Brothers was the most classic example of that time. In one night, they went from a prestigious Wall Street name to worthless paper, and even their name couldn't be saved, right? Even the name couldn't be saved. Why? Because bad debt skyrocketed. Provisions couldn't keep up. Cash flow dried up, and it was game over. So, how do big banks survive? So, why do some of the big banks manage to weather the storm? For example, JP Morgan Chase, Citigroup, and the Bank of America, these giants. Let me check the JP Morgan. These giants is because they have money, diversification, and provisions. What are provisions? It's when a bank sets aside a portion of its profit as a buffer in case someone defaults on a loan. With that cushion, it's much harder for them to suddenly collapse. So as you can see, while this industry might seem stable on the surface, there are a lot of barriers behind the scenes. What should we retail investors focus on? For us retail investors looking at bank stocks, we need to focus on two things, not just the headlines. Not just the headline. Let me show you the headlines. Not just the headlines, okay? First is their real growth in lending volume and the interest rate spread. Is there real growth in lending volume and the interest rate spread? Don't just focus on the size of the numbers. We need to check if the lending is healthy. Are they lending to people who can actually repay? Second, is the bad debt ratio under control? As long as bad debt is manageable, banks remain a solid choice during periods of high interest rates. Last year, we saw a classic pitfall with Silicon Valley Bank, SVB. Let me show you the Silicon Valley Bank. The ticker is SVB. Oops. Silicon Valley Bank. Oops, can't find it. On the surface, they were lending money and had plenty of customers, but once their bonds went sour and bad debts piled up, plus the risk control didn't keep pace, the bank collapsed overnight. We can't even find them right now, right? We just tried. Depositors and shareholders were left stunned. So, for retail investors looking at bank stocks, prioritize the big banks and be cautious with the smaller ones. Let me share my 3 golden rules for investing in bank stocks. Keep these in mind. Avoid the small ones. Stick with big banks like JP Morgan Chase, JPM, Bank of America, BAC, and Goldman Sachs, GS. These giants are more resilient with diversified business models, dividends, and share buybacks. Look at lending. My rule 2 is look at lending, but also pay attention to bad debt. Don't just go by the headline saying record high lending volumes. You need to check the financial reports to see how much they are set aside in provisions and whether the bad debt ratio has increased. Rule 3, don't go all in on high dividend stocks. Bank stocks are often seen as stable dividend payers, and many people treat them like saving accounts. But if the economy suddenly slows down, dividends won't be enough to stop the stock price from taking a massive hit. Let me check if anyone asked questions. Let me check. Oh, someone asked, hello, with such high interest rates, can we still hold on to bank stocks? Short term it's stable, but you shouldn't just hold them blindly. As long as the interest rate spread stays wide, bank stocks will remain supported. However, if the economy takes a turn, for example, if the unemployment rate suddenly spikes, the quality of lending will suffer and bank stocks will likely drop first. Oh, I see another person asked, I'm losing a bit on my bank stocks. Should I average down? Yes, you can average down, but don't do it all at once. Do it in stages and keep an eye on the economic data. Look out for a rise in unemployment or an increase in commercial defaults. If there's a real shift in interest rates and the market starts to expect rate cuts, you should be ready to adjust your portfolio. Don't just hold on to high interest spread stocks. For example, if a friend goes to dinner with their wife tonight and she asks, hey, aren't you worried about the risk with bank stocks? You can tell her, no worries, I'm sticking to the big banks, not the small ones. They have dividends and provisions. Even if something goes wrong, I'm not going to lose it all. Go all in is what's risky. Okay, my friend, a lot of people keep asking me, hey, how do I balance bank stocks with tech and energy stocks? How should I allocate my positions? This is really hard to explain in just one sentence on a live stream. I also share my portfolio examples in the WhatsApp group from time to time. If anything sudden happens, like data change, rate adjustments, or bad debt ratio spiking, I will send out a quick reminder in the WhatsApp group. So if you are serious about learning, you really need to join that group. Don't delay. All right, everyone, we've just talked about Trump's tax reform and bank stocks, and now we're going to dive into the energy stocks. Energy stocks, which have been making quite a bit of noise lately. Why focus on energy stocks? Some of the new viewers might be asking, hey, what's so special about energy stocks? Don't they just follow oil prices? That's true on the surface, but it's not that simple. Energy stocks are influenced by a mix of global supply and demand dynamics, geopolitical issues, and the hedge fund battles with big money. These factors combined are what cause such large fluctuations in energy stock prices. What's the news? Well, recently this news came out. Hedge funds have started dumping energy stocks in large quantities. And what are they selling? Some of the most familiar big names: ExxonMobil, XOM, Chevron, CVX. Let me show you. ExxonMobil, XOM, this one, and this one, Chevron. Let me check. Chevron, CVX. Both are industry giants, and when they decided to sell, they really sell. Why are they dumping? It's not because the companies have bad news, but because they believe oil prices have peaked in the short term. They're taking profits off the table while they can. How do hedge funds play this? Sometimes the retail investors think energy stocks are just about following oil prices, but when it's buy when it's going up, sell when it's going down. But what's the strategy of hedge funds? They play it by positioning early and selling before the crowd. When they expect oil prices to rise, they position themselves 6 months to a year in advance. When they think oil prices are about to peak, they sell off early before the news hits. Then, when the news comes out, retail investors see it and rush in. By that time, the institutional money is already out, and the retail investors end up buying at the peak, taking the last leg of the move. Let me tell you a true story. One of my longtime followers got caught in this trap last year. When international oil prices broke $100 per barrel, the whole internet exploded with headlines like, "Oil prices are going through the roof, energy stocks are soaring, and Chevron's dividends are looking great." Without thinking twice, my follower jumped in and went all in. But within a month, what happened? Oil prices didn't keep rising. Instead, they started to drop. And ExxonMobil, XOM, followed, losing several points. Why? The hedge funds had already positioned themselves when oil was around $90 per barrel. When oil hit $100, that was their profit-taking point. And by the time retail investors rushed in, the big money had already made its exit. This is why I always say, when it comes to energy stocks, don't just watch oil prices. Pay attention to the flow of big money. What's the logic behind oil prices? So why are oil prices starting to struggle a bit now? There are two key factors. The first one, short-term supply and demand pressure. There is inventory and new supply is coming in, like how US shale oil producers have opened up a few more big wells. OPEC may be talking about cutting production, but behind the scenes, they sometimes have disagreements, so the supply isn't as tight as people think. The second one, demand hasn't surged. The global economic recovery isn't happening as fast as expected. Europe is still struggling, and Japan is barely picking up speed. Without a spike in demand, oil prices can't hold up. So, what does this mean for retail investors? What should we retail investors learn from this? Two words: don't be greedy. Energy stocks, don't be greedy. Energy stocks are classic cyclical stocks. They go up for a while, then come down. Where there are profits to be made, there are always people who end up holding the bag at the end. What should we do in this situation? Let me share my personal approach. This is not investment advice, just how I typically handle things. Feel free to use it as a reference. First, watch the short-term oil price range. If oil prices fall back to $65 to $75, OPEC usually stepped in with statements about production cuts to stabilize the market. This range is typically a good opportunity for a low entry position in energy stocks. Second, don't blindly chase. Buy in stages. For stocks like XOM and CVX, if you're aiming for a short-term rebound, don't buy everything at once. It's better to split your purchases into 3 to 4 rounds. For example, add a little every time the price drops by 3%. Third, focus on swing trading with dividends as a secondary consideration. A lot of people are attracted by the dividend from energy stocks, but if the stock price drops in the short term, that 4% dividend won't be enough to offset the loss in value. So make sure you understand this. Energy stocks are for swing trading and benefiting from policy expectations, not for long-term buy and hold. Let me repeat this. I want every one of you to remember this. Energy stocks are for swing trading and benefiting from policy expectations, not for long-term buy and hold. I saw someone ask, after this wave of selling, will hedge funds buy back energy stocks later? Great question. Hedge funds aren't saying they will never touch energy stocks again. They're just taking profits at this price level, thinking that oil prices are unlikely to rise much further from now. They think that oil prices are unlikely to rise much further for now. But if oil prices drop to a certain range, say if supply and demand tighten again, or if there's more geopolitical tension, they will definitely come back in to position themselves. So what should we focus on? Focus on the oil price range. Watch the OPEC meetings and keep an eye on news from oil-producing countries. Another good question, I saw it. Is it a good idea to use energy stock as a hedge along with gold? Is it a good idea to use energy stocks as a hedge along with gold? This is something a lot of people overlook. Although both energy and gold are considered commodities, the logic is different. Gold is purely a safe haven asset, while oil prices are influenced by supply and demand, geopolitical factors, and economic conditions. If there's significant global risk, like escalating geopolitical conflicts, oil and gold might both rise. But during economic downturns, oil prices could fall while gold might strengthen. So some people combine gold and energy stocks in a portfolio to hedge against each other, but be careful not to overweight either one too much. Typically, a 10% to 20% allocation in gold is sufficient, and the rest should be spread across energy and other sectors. A lot of people keep asking me, what's your outlook on oil prices? How do you draw support levels? When will hedge funds come back in? My friend, I'm literally watching this every day. Sometimes a single late night news update can cause XOM to gap up the next day. That's why I always share these real-time updates and my thoughts process in the WhatsApp group. If you haven't joined yet, click the link and get in. There's always someone in the group sharing news they've spotted. And when something breaks, we can discuss it right away to avoid making mistakes, right? All right, everyone, let's dive into the final key segment of today's stream. This is the last one, the US dollar and the global central banks showdown. Don't be fooled by the fact that it's at the end of the stream. This topic is just as important, if not more so. In fact, many people who trade US stocks their whole lives end up losing because they don't fully understand the dynamics of the US dollar. Why talk about the US dollar? Let me explain it to those who are new. Some people might think, hey, I don't trade Forex, I only trade US stocks. What does the dollar have to do with me? This is a big misconception. When we trade US stocks, we're essentially trading dollar dominated assets. When the dollar is strong, money flows into the US. When the dollar weakens, money may flow out. This has a direct impact on the earnings from foreign exchange for multinational companies and also affects whether foreign investors choose to invest in US stocks. Why is the US dollar so strong right now? Let's first set the background straight. Why the US dollar is so strong in this round? To put it simply, it's because the Federal Reserve is holding on to high interest rates and won't budge, which forces capital to stay in the US. This isn't just my opinion, folks. You can check the news for yourself. Yes, you can check the news yourself. It's almost everyone's opinion. The whole world is watching the Fed, waiting to see when they will finally ease up. Earlier, people were betting on rate cuts by mid-year, but when inflation data came out and wasn't as low as expected, Fed Chairman Powell immediately said, "We need more data to confirm." The market immediately cooled down. The dollar continued to consolidate, but it stayed at a high level without dropping. This has effectively shackled the global capital markets. We also need to watch the actions of other central banks. It's not just the Federal Reserve. The European Central Bank, ECB, and the Bank of Japan, BOJ, are also making moves. The ECB actually wants to cut interest rates to stimulate the economy, but if they do, the euro will weaken even more. The capital will flow into the US even faster. So they're holding back and don't want to ease up too quickly. The Bank of Japan is even more interesting. Let me tell you, have you seen how much the yen has depreciated recently? It's been so extreme that they've had to intervene in the exchange rate and make statements to stabilize it. As a result, many people try to jump in and go long on the yen, only to be wiped out by the strong dollar. So the global currency war is really about who can hold out the longest before finally easing up. What does the strong US dollar mean for retail investors? Many people only see headlines saying the dollar is up, but the impact goes far beyond just exchanging currencies. First, when the dollar strengthens, commodity prices are usually suppressed. Look at gold, oil, copper, they are all priced in dollars. When the dollar gets stronger, other countries have to pay more to buy the same things. If they can't afford it, demand drops. Second, a stronger dollar means many multinational companies get hit by exchange rate losses. For example, companies like Apple and Tesla, which have a large portion of their revenue in foreign currencies like euros and yen, when they convert those earnings back to dollars, unfavorable exchange rates can shrink their profits. And third, Oh, sorry. When the dollar strengthens, capital tends to prefer US domestic assets. So during times of heightened risk aversion, US Treasury bonds and big US stocks may hold up in the short term, but emerging market capital will be easily pulled out. My friend, let me share a very typical pitfall. Recently, one of the guys in the group told me, one of the guys in the WhatsApp group told me he saw the yen depreciating badly and thought it was a good opportunity to go long. He thought it can't keep falling, right? This is a free money opportunity. But he didn't account for the fact that the Federal Reserve is sticking with high interest rates, causing funds to flow back to the US. When the dollar strengthens, the yen has no bottom. So just as he bought in, the exchange rate dropped another 2% and he got wiped out. This is why I always say when it comes to currencies, just because something looks cheap doesn't mean you should jump in. You need to consider the central bank's stance and the global flow of capital, right? How can retail investors avoid pitfalls? I've summarized 3 key points. Take notes. This will definitely come in handy. The first one, watch the fast tone plus key data. As long as core data like CPI, PCE, and non-farm payrolls aren't showing signs of easing, the Fed will stay hawkish, and the dollar won't easily plunge. The second one is when trading gold, energy, or forex, always keep an eye on the dollar. Don't just focus on gold or oil prices themselves. If the exchange rate moves against you, it can wipe out your profits, especially with gold. There's a strong inverse relationship with the dollar. Third, don't use high leverage on forex trades during high volatility. Forex isn't like stocks, it's highly leveraged. A single unexpected data release or central bank statement could wipe you out. So either trade with a small position to test the waters or just avoid it altogether. Oh, I saw that someone asked, hey, hi, if the dollar stays this strong, is there still a chance for gold? Great question. Gold is almost sensitive to 2 things, high interest rates and a strong dollar. But gold also has its own logic. In extreme risk-off situations like escalating geopolitical tensions or severe stock market volatility, large capital flows will often move into gold as a safe haven. So while a strong dollar does put pressure on gold in the short term, if an unexpected black swan event occurs, gold could rebound against the trend. I saw another good question. Hello, if the dollar suddenly turns weaker, will US stocks rise with it? This is something many people misunderstand. Okay, many people misunderstood this. When the dollar weakens, it usually means the Fed is shifting to a dovish stance and might cut interest rates. This is generally positive for the tech stocks and the growth stocks, as capital will flow back into riskier assets. But don't forget, if the dollar weakens too much, it could also signal economic risks. For example, the Fed cutting rates might indicate the economy is facing a hard landing with a spike in unemployment. So we need to assess whether the dollar weakening is a good sign, rate cuts plus soft landing, or a bad sign, economic recession. It's not a one-size-fits-all situation. Folks, I know some of you are busy during the day and don't have time to keep an eye on CPI data, non-farm payrolls, or the Fed's dot plot. By the time you realize what's happening, the market has already moved for days. That's why I make sure to post the key data release dates, unexpected forex news, and the latest Fed comments in my WhatsApp group as soon as they are out. Plus, we have members in the group who traded gold, forex, and energy stocks, so we can all discuss and remind each other, helping us avoid falling into traps. So, if you haven't joined yet, make sure to click the pinned link below and join for free. Make sure you click the pinned link and join the WhatsApp group. Alright, let's quickly recap everything. To understand if the dollar is strong or not, look at the Federal Reserve stance, how hawkish they are, and whether the data can support it. And next, gold, oil, forex, and multinational company earnings. All of these are tied to the dollar. And then, don't trade in isolation. Always keep an eye on the global central bank battle. For those who got it, type USD in the chat so I can see who's still with me. Please type the USD in the chat so I know you're still with me, okay? Alright, we're almost at the end of tonight's live stream. First, a big thank you to everyone who spent these almost 2 hours with me, going through the most critical news and market trends together. From the impact of Trump's tax reform on big companies and multinational giants, to how Wall Street banks are maintaining profits in a high interest rate environment, to why hedge funds are selling off energy stocks and the supply-demand dynamics behind oil prices, and finally, the global central bank battle, why the dollar is strong, and the relationship between gold, oil, forex, and US stocks. If you are still here with me, if you are still here, I hope you are still here, okay? It means you're not the type to just scroll past it quickly. You really want to avoid pitfalls in the US stock market and then make smarter moves. I'm so happy you're still here with me. I know a lot of people are busy during the day and can't keep up with the data, then quickly scroll through it at night before bed. The thing with US stocks is that the information gap can really hurt you. Waiting just one day can cost you several points. So if you want more specific entry points, how to allocate your portfolio, adjust your positions, or hear my first thoughts on breaking news, the easiest way is to join my WhatsApp group. Many of you who are already in the group know that I don't post unnecessary chatter or try to sell courses. It's totally free. I focus on practical information, how I analyze the latest economic data, which sectors to watch out for risks, where the good entry points are, any breaking news, or when it's time to adjust the positions. I will share my thoughts right away to help everyone avoid pitfalls. Sometimes when I'm too busy to type, I will share screenshots of my positions or portfolio examples, so you can use them as a reference and avoid taking the wrong turns. Don't wait until you're stuck in a losing position to regret. Join right now. Also, sometimes some of you want to ask about your positions or have your portfolio checked. Whenever I see your messages, I usually try to take some time to respond. After all, as retail investors like us, it's hard to keep track of everything alone. It's much better when we all keep an eye on things together and remind each other rather than going it alone, right? And don't be afraid to ask. If you don't understand, just ask. By the way, if tonight's live stream helped you, don't mind taking a moment to hit the like button and subscribe. YouTube's recommendations depend on how many likes, comments, and shares we get. By clicking a like and subscribing, you're giving me the biggest support. I really thank you. I really appreciate it. And also making sure you get notified about my next live stream as soon as it starts. Some of you might have just joined and didn't see it earlier, but the link to the WhatsApp group is pinned in the comments and also in the video description. Just click the link, fill in your name and you're in. It's free. No gimmicks, just a group of like-minded people chatting together. That's about it for today. I hope everyone's accounts are looking green tonight. May we all make more profits and minimize losses and continue to grow more stable over time. Next time I go live, I will post the notifications in the group ahead of time and share any new updates so we can avoid the pitfalls together. Alright everyone, thank you for spending these 2 hours with me. I will see you at the next live stream. Don't miss it. Wishing you all good night. And if you want to learn portfolio management, know how to adjust your positions, or need one-on-one reminders, simply join my WhatsApp group. We chat there anytime. It's free and convenient. The link is in the pinned comment. Don't miss out. Goodbye.